We want to bring in Andrew Levin. He's a former Federal Reserve Board special advisor and economics professor at Dartmouth. Also, Elyse Ausenbaugh, JP Morgan Global Market Strategist. Andrew, first to you, because Powell signaling that the Fed could stay a very aggressive 75 basis point hike today, 50 to 75 on the table for July. Does that type of policy, that aggressive a policy, make sense to you?
I think that the Fed is making the same mistake now that they've made persistently over the last year, more than a year. Let me be concrete. The Fed just released a fresh set of projections for inflation, what it expects inflation to be this year. Okay, now we're already halfway through the year. They are projecting that headline PCE inflation is going to be about 5% for the year as a whole. Now think about this for a moment. The inflation rate for the first half of the year is at around 7, okay, for core PCE. In order for them to get that forecast of 5, that means that for the second half of the year, inflation would have to be at 3, which seems very unrealistic. Now, with core inflation, their projection for the year as a whole is 4.3%. But core inflation, PCE inflation, is running at 5 for the first half of the year. So that means they would have to drop very rapidly to 3% over the next 6 months. I think the Fed is being still too rosy, too optimistic, and probably the actual rate hikes they're going to have to do over the next 6 months to a year is going to be much more significant than what seems like it could work if the current forecast actually materialized. Okay, but that seems to me quite unlikely.
Okay, at least we want to back up just a bit and get your reaction to first the hike, 75 points, first time since 1994. And now your reaction to Andrew as well on the tail end there, that the Fed is being too rosy, too optimistic.
I mean, they should be. Sorry, please.
I was going to say that if you would have asked me a week ago, we would have thought that 75 basis points would be a big surprise. But of course, coming off of the Friday inflation print, and the way that the market moved really quickly to price in that probability, not a surprise. I personally think, and JP Morgan thinks, that the Fed's not necessarily being too rosy. A lot of economic data from even today kind of got lost in the Fed shuffle, but we are already starting to see signs that economic activity is slowing down to a degree that should continue to cool inflation. I think Powell did a really good job of managing the market's expectations and letting the market know that there's got to be some optionality at play here. To think that the Fed might tilt dovish in the months ahead, I think would perhaps be, that would signal that someone's being misled about their expectations. But putting 75 basis points on the table for July and then again seeing what happens in September, I think remains kind of the right mindset.
And Andrew, we did see that the markets jumped, as Chair Powell laid out, really the thinking behind the rate hike, as well as we heard these terms moving nimbly and moving expeditiously. We heard those words peppered throughout his press conference. What will he have to do then between now and the end of the year or in the future sessions to really try and meet these goals that he's looking at for inflation?
Well, I think it's helpful that the Fed emphasizing the same day they're strongly committed to bringing inflation back to the 2% goal. But in my view, they have a long way to go. Inflation doesn't move normally that quickly going downward. And they've emphasized China, they've emphasized the commodity prices, the labor market. Nominal wage growth now is running at 6 or 7%. That's not consistent with a 2% inflation rate. And the housing prices and the rents are still going up. So I think there's a risk, actually, that inflation is going to be higher at the end of this year than it is right now.
Elyse, one thing that Powell also did say is just in terms of when the Fed wants to meet its objective of bringing inflation rate down to 2%, he wants to do that while the labor market remains strong. Do you think that's possible?
We do think it's possible. One of the things that he pointed out in the context of that comment was that there continues to be this surplus of demand for labor and the supply has not yet caught up. So I think it is realistic to think or assume that we could see that slight uptick in unemployment over the next couple of years, but not necessarily a dramatic spike that would have, been reflective of what we saw in 2020 or in 2008 coming out of the global financial crisis.
And Andrew, to your notion about rosy and optimistic, it was a surprise to hear Powell say, and I'm going to quote, "There's no sign of a broader slowdown that I can see in the economy." Instead, what would you like to have heard from Powell there?
Well, I think the realistic scenario that I can see, and I agree with Elyse, I think that this morning's retail sales report was important. What I think we're heading for now is what economists used to call stagflation. That means very weak, kind of close to zero economic growth, combined with continued elevated levels of inflation. That's the likely scenario here. And it's not a very rosy one. Consumers are not going to be any happier 6 months or a year from now than they are today, because their real incomes won't be rising.
So then, Elyse, in terms of your clients, whether or not they were expecting this 75 basis point hike, where do people position themselves now, knowing that we're still in this rate rising environment, that we could see more aggressive action coming out in future sessions?
I think people need to revisit their goals and assess whether they're going to be able to stay on track towards meeting those goals while taking less risk. When you can get 5% from investment grade corporate bonds or municipal bonds on a tax equivalent basis, that looks really compelling, especially when you consider the confluence of risks and the amount of uncertainty that's likely to continue to weigh on the equity market. It doesn't mean that investors have to blow out of stocks, but we are encouraging folks to focus on upgrading the quality of those positions, leaning into sectors like healthcare, which historically have proven to be very durable, regardless of whether we were in an economic boom, bust, or somewhere in between. And also considering using some of this volatility to our advantage by putting on structured notes that allow investors to participate in the stock market with some downside protection.
Elyse, what do you think has been priced into the market at this point? A 75 basis point hike in July. Has that been priced in yet?
Yes, I think so, because what the Fed just came out with in terms of those forward-looking projections in the dot plot, we pretty much saw that adjustment in markets over the course of Monday and a little bit yesterday. So at this point, I think these hawkish expectations are pretty well embedded. And of course, as Powell said, we're going to have to kind of take a data-dependent approach to this. We, in particular, do think that interest rates are likely, it's hard to say that they're peaking right now. We are probably going to continue to see some rate volatility, but over the longer term, a 1 or 2 year time horizon, we do think that interest rates are going to be biased to the downside. And so we're comfortable adding duration, but you can also look at opportunities on the shorter end of the curve if you are really concerned about that interest rate risk, and certainly at the very least use that as a means of liquidity management.
And Andrew, as we look at, obviously, we're focusing on what the Fed can do in terms of raising interest rates and also trying to tighten with their quantitative easing. But what about things that are outside of the Fed's control? What are some of the indicators that you're keeping an eye on there?
Oh, that's a great question. I think that unfortunately it looks more and more likely that the situation in Ukraine is going to drag on for a long time to come. It's a horrific situation, but that's going to have big global consequences, as Chair Powell emphasized today. The situation in China doesn't look like it's getting better. And so what we were hoping for was supply chain disruptions would be starting to ease this year. If anything, they might get worse because that situation in China is very, very difficult.
Certainly lots to watch for. A big thank you to our panel, Andrew Levin, there, former Federal Reserve Board Special Advisor and Dartmouth College economics professor, and Elyse Ausenbaugh, JP Morgan Global Market Strategist. Thank you both.